Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video tutorial I want to talk about why I hate stop loss orders. And again, today we're going to completely close the case as to why using stop loss orders actually creates more losing trades with risk-defined strategies. And I know it's probably hard to believe now because you've been probably taught in so many different schools and classes and courses online that you've got to use stop loss orders because they protect you, but frankly they create more losing orders. I'm going to show you why they do it because it's not something you can argue with. It's based 100% on math and probabilities, and again, you just can't argue with these numbers. So remember, this is strictly for risk-defined trades. So these would be credit spreads, iron condors, butterflies, debit spreads, etc. If you've got undefined risk trades, those are going to be a little bit different. And I think that at some point you could use a stop loss because you got to just cut the bleeding. You don't want to have unlimited risk in perpetuity. So here's why stop loss orders don't work. And it all comes down to the fact that in the markets, we can calculate exactly the probability of an option expiring out of the money. In Thinkorswim, our broker that we use what's called probability ITM. And you can see for this SPY trade that we had, we sold a credit call spread above the market. So we sold the 208 options, which is the line highlighted, and then bought the 209 options above that. So it's risk defined. We know exactly how much we can make or lose. In this case, SPY is currently trading at 201.63. Now the probability from the time that we enter this trade until expiration, which is about 34 days, it's February expiration, the probability of us losing on this trade, or SPY being in the money, meaning closing beyond our 208 strike, is just 23.39%. So that means that we're trading with better than 75% chance of success on this trade, because the likelihood of SPY going all the way up to and above and staying above, more importantly, 28 between now and expiration is 23.39%. Now that's a high probability trade. That means that 3 out of 4 times you're going to win on this trade. So that's a really high probability trade if you let it go all the way to expiration. Now here's why stop loss orders create more losing trades. Because if you have a stop loss order in here and you start to lose on this trade, the stop loss order is going to trigger it and it's going to get you out of this trade. Specifically, what we find when we calculate the probability of a touch, and probability of touch means SPY at some time between now and expiration goes up to and just trades at one time, just one contract or one share traded at 208, the probability of that happening is 48%. So it's almost double the probability of SPY staying up there. If we put it another way, it would be saying it like this. SPY has a 75% chance of closing below 208. But a 50% chance of at some point trading at 208. So that means that 3 out of 4 trades are going to be winners if you let them go all the way to expiration. But during that process, 2 out of 4 trades are going to be 100% losing trades at some point between now and expiration. And half of them are going to come back in. So it's a really, really powerful stat that, again, you just can't argue with. The probability of touch is almost always double your probability of losing on the trade. So that means that more than 50% of the time you're going to be holding a losing trade that won't end up being a loser. So if you use a stop loss order, you're actually going to be closing a trade that may come back in and become a winning trade. And that's why I think that stop loss orders create more losing trades. The best thing that you can do is trade small and trade high probability strategies because you can let them go all the way to expiration. Using a stop loss order would get you out of this trade with a loss 50% of the time compared to just leaving the trade on and doing nothing, kind of the lazy trader mentality that we talk about. Leaving the trade on and doing nothing, you'd actually have a higher chance of success. So here's just one example of many, many, many more from my own trading account that we recently just experienced. So we had also sold a credit call spread above the market in XLE. And you can see here we put the date of the trade. So we sold this strategy on 12/10 and it was a 78 80 call spread above the market. So ideally, this trade would be losing money if XLE traded anywhere above 80. We'd be losing a lot on this position if it kind of stayed up there. Now, we traded this spread and sold it for $62 per spread, and we did 4 of those. And you can see that right now, with 2 days to go until expiration, the spread is currently trading for just $2, and we've got about a $240 profit. But it wasn't always this way. So here's a chart of where XLE was trading during the duration of this trade. Again, you can go back and look at this because all of this stuff is pulled right from our broker. We don't mess with any of these charts and kind of move things around like other guys that we've seen out there do. We know that this is all factual evidence with regard to trade times and trade prices. So the red circle on this chart, this is the actual day that we made this trade. This is on December 10th. And we sold that call spread above the market. And the blue line on this chart represents where our short strike is at 78. So you can see that as soon as we made this trade, we had a little bit of good movement in the stock. The stock went down. That's what we wanted to see. But just 3 days after we made the trade, the stock went on a rally and started to trade above our short strike. So for this about week and a half to 2 week period, the stock was trading completely in the money. This is that probability of touch that we were just referencing on SPY. So the stock was trading all the way above 78. It was actually trading about 80 for a week and a half. And at that point, we were actually holding a full loser. We had a full loser on our hands. We weren't going to make a dime on this trade. But we didn't close out the trade. We didn't use a stop loss. And you can see it did, in fact, come back in and ended up being a big, big, big winner for us in our portfolio. So again, this just really proves the point that with these risk-defined trades, you've got to let them go all the way through until they show a profit. And if they don't show a profit right away, know that almost half of the time, those ones that are showing a loss will show a profit. And that's just the way that the numbers work out. And you can't use stop losses because had we used a stop loss, in this case, it would have created a major loser. So again, using stop losses or trying to adjust, we might have ended up with a losing trade on this position versus just waiting and let the numbers work out in our favor. And again, this really kind of closes the case. With stop loss orders, they create more losing trades because they get you out early when you actually have a higher probability of success waiting longer in the position. So as always, if you have any questions or comments, please add them right below this video in this lesson page. And until next time, happy trading.